Welcome to Talking New York Real Estate with Vince Rocco. Our show is all about the exciting world of real estate and in particular, how it relates to the luxury New York marketplace. But if you are not planning a real estate transaction in New York, we still have plenty of information you can use no matter where you are. Now, here's our show. Good morning, everyone. I would like to welcome my listeners and viewers in the United States and all around the world. I am Vince Rocco, and it is Tuesday here in New York City, so let's go behind the headlines and get the real story. But first, this is Talking New York Real Estate, the state of our industry. And up front today, since the Fed Reserve recently dropped interest rates by 50 basis points, and there is serious talk about additional cuts, the financing options for New York City real estate buyers have become more favorable. Lower interest rates have made traditional fixed-rate mortgages more attractive, offering buyers the opportunity to lock in lower monthly payments over the life of the loan. Adjustable rate mortgages, or ARMs as we call them, which often start with lower rates and are even more competitive in this environment, appealing to buyers who plan to sell or refinance within a few years. The rate cut also impacts jumbo loans, making high-priced properties in New York City slightly more affordable through reduced borrowing costs. First-time buyers may find FHA loans more accessible as lower rates reduce the overall cost of borrowing. Additionally, some buyers are using rate buy-down options or negotiating better terms with lenders to take full advantage of the lower rate environment. With those needing short-term financing, bridge loans have become less costly, and private banks are offering more competitive portfolio loans. Overall, the Fed's rate cut is helping ease some of the financial pressure on New York City buyers. The experts I have today are here at the table with me. We're going to talk about that, discuss all of that, and have so much more as Talking New York Real Estate gets underway on this Tuesday morning. And in the news this morning, the Real Estate Broker Confidence Index for the first half of 2024 showed that residential and commercial brokers had begun to align more positively on market conditions, but remained skeptical until recently. Residential brokers were bullish thanks to strong market activity back in 2022 and 2023, while commercial brokers had been bearish due to continued shortfalls in office leasing. However, with interest rate cuts already underway, future confidence is improving, and by the second half, I suspect we will see a much more improved outlook. And from the desk of my chief economist, Greg Heim, 254,000 jobs were added last month, which easily crushed the 150,000 Dow Jones forecast. If that wasn't enough to make you smile, employment in July and August was revised upward by 72,000. That's especially nice since we had our fill of downward employment revisions over the past several months. And other highlights of his report this week, the unemployment rate ticked down to 4.1%. All the employment gain last month was in full-time jobs, according to the household survey. And the household survey also had total employment up by 430,000 in September, which gives us even more confidence about the headline number. The number of job openings rose to 8.04 million at the end of August. Initial jobless claims remain at historically low levels, while the number of continuing claims for unemployment fell. September data showed a higher than expected increase of 143,000 private sector jobs. And a huge part of the job gain last month was in healthcare, government, and social assistance. That means 41% of September's job growth was in government jobs and private sector industries that aren't tied to the health of the economy. He finished with, the labor market has been a bit shaky the past few months, but September's great jobs report should calm things down for a few weeks, we hope. So he doesn't expect that this will stop the Fed from cutting rates at their next meeting in November, even if it would. October's job report comes out a week before they meet, so September will be old news by then. And finally, one of New York City's most unique homes hit the market this week. The Greenwich Village townhouse at 16 Minetta Lane underwent a 10-year renovation led by owner and architect Adam Kushner that transformed the original building and rear carriage house into one unbelievable compound, leaving the exterior structures intact. Kushner constructed a new interior separate from the original building, creating a front courtyard between old and new. It's asking $20,065,000. The home measures an incredible 4,200 square feet with 4 bedrooms, a rooftop lounge, and an 83-foot outdoor rock climbing wall. I mean, only in New York, kids, only in New York. With me at the table today are Spencer Corrente from Alkaline Advisors, Matthew Mellinger from Brown Harris Stevens, Jared Anton, Elegant Forbes Global Properties, and Stephen Lasher from Wells Fargo Bank.
Hi, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you know the right partner makes all the difference. At Roadway, we deliver an experience your clients will love. For specialized services and white glove care, choose Roadway. Want to learn more? Email me at stephen@roadwaymoving.com or visit roadwaymoving.com.
Okay, everybody, we are back. So we're going to talk to the experts today as I open the show with some of the changes in the Fed cut in the interest rates, how it's really affected the mortgage rates. We have two mortgage bankers here. We have 2 brokers here. And also, just kind of a flavor of what the market is doing. We've been ending every show the past couple of weeks with the status of the market today. I want to talk a little bit about new development. I want to talk a little bit about, co-ops and condos that are not brand new and where we are in the marketplace, because the hope is that by the beginning of next year, as we steamroll through the end of this year, that activity picks up even more than we've seen it already, because there have been pockets of where, activity has picked up, but we want to get it even more. But Spencer Corrente, I want to start with you. So, you are my Renaissance man here. You launched Alkaline Advisors in the spring of 2022. And have since assisted 100-plus organizations ranging from boutique investors to global institutions. Your past includes a New York City-based commercial real estate investment bank and working as a residential mortgage broker when I first met you many years ago in new condo developments and lender relations. Tell us a little bit about your background and a little bit about your current company and what your goal is moving forward.
Yeah, definitely. First, Vince, I want to thank you for having me back. I think today this week marks the 8th year anniversary since we did this originally. So it's fun to be back here.
You remember that? Well, yeah. That's about right. 8 years. I was going to say 9, but okay, there you go.
I started Alkaline Advisors back in 2022, and it really kind of happened organically. So as you said, my background's in real estate banking, and what we do at Alkaline is a little different. We are financial analysts. So I say that we are an outsourced analytical group. We'll work with all sorts of groups across the real estate industry, from developers, family offices, private equity firms, lenders, brokers, asset managers, you name it. And what we do is we help these groups actually model out their projects or their investments in Excel. And what we do is, whether it's a development or an acquisition, we'll help them figure out how to structure the capital stack via debt or equity. If there's other debt vehicles like pref equity or other equity sources like limited partnership or general partnership. And it's really interesting because we work with all shapes and sizes of groups. I think our largest deal we worked on this year was $3 million, and then our largest was $512. And then our smallest group that we worked with had 1 employee, and our largest has over 500. So we really have a good understanding kind of what's going on in the market before the market has an understanding of what's going on in the market.
That's big, because sometimes they don't have it. But do you get involved at all in any type of residential lending for condos or co-ops, or you just kind of stay away from that business?
Yeah, so we don't really get involved in much residential lending, but I would say that what we do has bearing on the residential lending market in a sense, because, when we're working with developers who are building condo buildings or single family communities, and we work with groups across the country, I think we're in 35 states, ultimately their end goal is to sell out, right? So they need to prove to their commercial lender that they will not only sell out of their space, but their buyers, who will inevitably own the end units, will be able to finance it. So I think, it's really all interconnected in that capacity.
Where are you located?
So I'm in San Diego, California, which is a pretty amazing place. But I used to live here, and it's always great coming back. The energy is palpable.
But San Diego is kind of cool.
San Diego is kind of cool.
Stephen Lasher, old friend of Brown Harris Stevens, Halstead, and of all of us. So you're the sales manager and founding member of the private mortgage group at Wells Fargo. And you joined them in 2003. So I thought I was working here a long time. I joined here in 2002. You're always part of the President's Club. Tell us about the overall, from your perspective, the overall climate that we are looking at and dealing with here in New York City as an industry in real estate? What do you see? What do you think that we can improve?
Sure. Well, as always, thanks for having me. It's great to be with you, Vince. And we look good for having been here for 20-some plus years, don't we?
Yeah, we do.
I'm excited about the surge in activity we've seen. I mean, we've continued to be busy, candidly, over the last 12 to 24 months. In terms of pre-approving buyers that are out there looking to acquire residential real estate and need a place to live. Unfortunately, transaction volume has been way down during that period of time. I would say post-Labor Day, we've seen a really nice increase in not only new buyers coming to the market looking to be pre-approved, but buyers that had been kind of, jumping around over the last 12 to 18 months, really re-engaging, looking to update their pre-approval so that they could action things forward. And we've seen volume really increase over the last 6 weeks or so.
Let me ask you a little bit about pre-approval, How has that maybe changed in the new climate that we've been dealing with over the last year and a half, 2 years, with higher interest rates than we've been used to? Are the pre-approval is the pre-approval process any more difficult for a buyer, or is it about the same, or has it changed at all? I mean, honestly, I've heard things post pre-approval that banks at the last minute have been pulling back on agreeing to financing, like right at the minute, right at the closing table, right a day before. Again, not to be specific, but how's the pre-approval process been working these days? I mean, I know it's a two-pronged approach, the buyer and the building, but what's been happening there?
Well, I think most importantly, a proactive customer, a proactive agent is a successful agent. So I think it's extremely rare, when we're managing a client transaction that we are pulling back last minute like that. I'm aware of it, right? And
I've heard of it. I'm not saying it's a standard. I've heard of it.
Sure, and it happens, right? We live in a world here in New York where we have vertical collateral, right? That creates a lot of complexity to what it is that we're doing. And so I think it's imperative that both as agents and mortgage bankers, we really are working together to, get ahead of those things. As an agent, if you're listing property, you should be engaging mortgage bankers early on to understand, is the building financeable? Are there local law 11 issues like swamp that may exist? And, what needs to be done to, get ahead of it and rectify it so you don't see those issues last minute. In terms of, pre-approvals, I actually think that things have really improved. I think there was a period maybe 24 months ago where banks were starting to really recession-proof and become a little bit more conservative with our credit policy for a period of time, just because there was so much uncertainty in the economy. I can tell you this, we've started to really open that box up again and expand our credit policy. And so, there was a period of time that we were not lending, 80% to $3 million interest only. We are again. Right. So I think things have actually improved.
Before we get into the nitty-gritty of, the financing end of a real estate transaction, Jared Anton from Elegran, I want to ask you about your report that I just read this morning. So from a supply perspective, you guys say Manhattan new-to-market supply in Manhattan dropped by 3%, leaving 6.578 properties for sale. In Brooklyn, inventory dropped by 2.5%. So what's happening with the inventory dropping at this point, when we all wish and hope that, we can see more inventory come to market, therefore stimulating the market for buyers and for sellers?
Absolutely. And thanks, Vince. Always great to be around here at this beautiful new table. What's really important
Always controversial, this table.
Check us out on YouTube. You can leave your comments for which table you like the best.
Exactly.
Supply has been doing funny things. Usually, right, in the seasonal component of our market, supply comes on immediately after Labor Day. That first week in September is usually the busiest in terms of new supply, and then it trickles down with decreasingly amounts of new supply each week. What's really important, though, typically the overall total volume of supply doesn't start to decrease until late October or early November. Both Manhattan and Brooklyn logged a decent 2% and 3% respective drops in supply after the first week in October. So this is unusually early and could cause some concern for buyers because, as we've seen, the recent drops in interest rates have definitely spurred buyers to come on the market. Our report calls Brooklyn now a buyer's market, but buyers shouldn't get used to it for long. Brooklyn supply is actually up about 10% to almost 15% year over year, whereas Manhattan is down almost 10%. So Brooklyn, which was for a long time so supply constrained, is following more of a national market trend that's seeing a bit more supply. But Brooklyn, which also saw a little bit of a demand compression, is starting to see that unlock with the interest rates. Manhattan, though, is remaining a bit more supply constrained. So all in all, it's keeping a very, very tight market. When you look at the interest rates, too, some really, really important things happened. One is rates are down about 150 basis points, or a point and a half, since their previous high about 1 year ago today. So last fall, when we look at what the contract volume is, it was slow because rates were substantially higher. Rates are down about 100 basis points, or 1%, since April. So there's been this really, really good progression. Now, what's really important to know, though, is many buyers were spurred to get into action because they were waiting for the proverbial rates to drop. And when the Fed made their headline, 50 basis point drop in the Fed, mortgage rates are actually up 50 basis points since then, right? Consumers need to see sort of that guiding light. So they were spurred into action by then, but it's really that first mover advantage. So rates will go down. They rose a little bit now with some of the Iran, Israel, oil price, some of the other external factors. Rates, should go back down. But it's very interesting to see that, how consumers react to sort of that guiding light rather than some of the most important or tangible pieces in what is the rate today.
And with all that said, under the contract signed section of your report, it says, contract signings increased by 5% over the past week in Manhattan and 19% in Brooklyn. So one would sit back and say, well, inventory is tight. We don't really have that much to show or sell. Buyers are kind of maybe still on the fence. But yet, contracts are being signed higher this week than last. What do you attribute that to?
It's just a matter of
mindset? Or?
It's largely a mindset, right? Buyers want to know that we're in this new normal. So the Fed signaled that we were at the end of that, higher for longer monetary policy, and we're now entering a new normal where rates are going to start to decline. So that creates a new mindset where buyers are like, okay, I was waiting for rates to drop. It's time to start. Keep in mind, too, that we've had now 2.5 years of these higher interest rates, right? Spring 2022, April is really when they started rising. And the average holding period for Manhattan properties is 3 to 5 years. People move very, very quickly. So naturally, we're coming to this period where people are timing out of their property, and you have people who have had that quote-unquote lock-in rate that has kept them where they are. So they're looking for the delta between their current rate and what's available in the market to decline so they can make that move. And as rates do drop, it's going to reduce that lockup and enable people to move. So I do believe we're about a point away from getting to this just large unlocking. And those of you that are regular listeners of the show have heard me say this before. But I do believe that when headline rates get to about 5.5%, you're going to see this huge reshuffle because people need to move. So get ready for it. This market will unlock.
Are we ready for that? I believe so.
We're very ready for that. No, but I couldn't agree more with, really everything that you said. I think in some of the data that you mentioned, I read something last week that said contracts on the Upper East Side had increased 37% year over year in the week, right?
Yeah.
And 31% year over year on the Upper West Side.
Yep.
And I think to your point, rates, they've dropped, about 1 to 1.5%. And when you think about that from an affordability perspective, right? On $1 million mortgage, if rates drop 1 full percent, let's say from 7% to 6% or 6% to 5%, you're talking about $10,000 a year in annual interest savings,
Absolutely.
right? That's $833 per month. So if you're buying in that kind of sub $2 million price point, those are real dollars, right, in terms of affordability. And candidly, if you're buying in that kind of 3 to 5 price point for that young family that wants to live in Manhattan, you're talking about $2,400, $2,500, $3,000 a month in savings if you're buying a $5 million property and borrowing $3 million.
That's a lot of money. Before we go to break, I want to just mention our friend Cale Goodman at Market Proof reported that 57 new development contracts were signed. In 38 buildings, 38 buildings selling new condos, 255 East 77th Street, had 9. And our friend Louise Phillips Forbes over at 393 West End Avenue had a bunch of them as well. So those are the 2 top-selling buildings in New York this week. So, look, I like to say, and maybe bullish on my part, but we're on the move. Okay, we're on the move. We're about to make changes. I agree with what Jared says all the time on the show. Probably by February, 5.5%, let's hope. And we'll start moving, and maybe 2025 we'll get there. We'll talk a little bit more about the state of the market at the end of the show, but we'll come right back in a few minutes. This is Talking New York Real Estate on the More Network. We're going to come back and talk a little bit more, drill down a little bit more on interest rates and how that may be affecting our buyers and sellers. Don't go anywhere.
The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
All right, we are back. So, look, there are a whole bunch of different approaches to our marketplace. But Matt, I want to ask you, with all the press recently about the reduction on the Fed side, on the interest rate side, and given what Jared just said before about mortgage rates not really changing yet, are first-time buyers seeing the opportunity for better terms when they go out to market, go out to their banker, go out to a financing institution to write, a mortgage or a financial package that's going to help them get into that home and not stress them from a monthly financial perspective? Because look, common charges have gone up, maintenance has gone up, real estate taxes, if it's a condo, has gone up. What they don't need is a higher mortgage rate on top of all of it. So They get a little skittish. What are you seeing in your book of business with first-time buyers and how they're thinking about getting into a good or better term mortgage?
I think that what was said earlier is 100% true. The Fed rate cut, while rates went up that day, it really brought more of a sense of consumer confidence. Yeah. And it sort of inspired people who have been on the fence that maybe I want to be one of the first people back in the game, because by January, February, there's going to be a lot more competition. Inventory is still extremely low in both Manhattan and Brooklyn, and also out east where I work. And that's only going to drive prices up. It's just simple econ 101. What I am noticing, as Stephen mentioned, is banks are getting a little less conservative, but we're not wild, wild west here, but it's becoming a little bit easier to process these applications, and they're happening a lot quicker. And there's a lot less, I would say, hurdles that first-time home buyers have to jump through in order to get pre-approved. The turnaround times seem to be getting a lot shorter. But there's still, banks are obviously doing their due diligence. I think in New York City especially, it's a whole other animal, because you're not just approving the buyer, as you mentioned. It's a 2-pronged approach. You have to also approve the building. And while buyers, I think, are finding it a little bit easier to go out and get the best rate possible from, speaking with multiple banks, the building side is where you see a lot of the resistance. It's not necessarily the consumer. They've done their homework. They know exactly what generally they're in for when they're going to apply for a loan. Yeah. But when they find that dream apartment, if the broker is not proactive, you're not requesting financials, you don't know about the buildings, you've never sold in it before, you don't know where they are in their local law 11 cycles. You don't know if they've had issues recently with replenishing reserves, special assessments, which are factoring into their monthlies. There's all these things, SWARM, which is the code word that we've been talking about for months now. These regulatory changes and new policies are really sort of like I would say the sleeper cells that are impacting a buyer, a first-time home buyer especially, their ability to actually follow through with a purchase. Yeah. But for all intents and purposes, the Fed rate cut gave everyone sort of a burst of optimism. Right. We expect that to continue, even though the mortgage rates, from what I can tell, are more closely tied to a 10-year Treasury curve. That's, a conversation a broker and the mortgage lender have to have with their clients to sort of educate them on how macroeconomic factors are impacting mortgage rates in real time.
Well, right. And any of us who have been in this business long enough know that it's always based on emotion and drama and what the news is reporting, whether things are going up, things are going down, interest rates are up, interest rates are down. So we have to learn how to manage those expectations. But what I've seen, though, which is a good thing, recently with the Fed cut, we are seeing that the mindset is shifting a little bit, hopefully in the right direction. And I believe, as I said before, that we're only going to get better. But Stephen, just to pick up on Matt's point a little bit, so from a building perspective, right, are you finding a lot more buildings having issues these days than in the past, or is it the opposite?
Well, the SWARMP issue has been a real issue for us. So SWARMP stands for Safe with a Repair and Maintenance Program. Right. It's a designation that's issued by the DOB when the Local Law 11 review is completed. And I think really the fact is most lenders, or at least I know at Wells Fargo, we can work our way through a SWARMP designation because technically the building is designated as safe. Where it really becomes an issue is when the building and their management company have not made the designated repairs of part of that review within the time frame that's been allocated, and then the building immediately receives what's called an unsafe rating, right? Unsafe scares anyone, right? Even your buyer. So even if we can work through an unsafe rating, which many times we can when we're holding the loan in portfolio, depending on where in the cycle they are, it's a challenge. So yes, we're seeing more of it. We're so used. I'd say one of the areas that we've excelled in over the years is, I've focused on the new development market. I'd say probably 50 to 60% of the transactions that I facilitate are in some sort of new development. So we're very familiar with kind of mixed use collateral where you may have, a Hudson Yards, an Essex Crossing, right? Or in Brooklyn, you have Front and York, some of these complex projects that are multi-use, but we seem to be working our way through it, without much issue.
We trug along and we get there. Spencer, let me ask you, so back to your business, when you're working, your day-to-day with whomever you are working with, what is the most complicated thing that happens in a transaction? I'm going to use the word transaction because I'm sure, what you do is transaction-based anyway. What is the most complicated thing that happens, or what is the most, where people get the most angst or feel the most, crazy about completing, a situation with you?
Yeah, that's a great question. I'll choose one specific group that we work with that I think ties in nicely to this conversation. So when we work with real estate developers, they're very much concerned about how they're going to fund their project.
That's what I wanted to get at.
Right. So if a project costs, let's say, $100 million, and it's a development, right? Mm-hmm. Everything is risk reward. So if they're looking to get, let's say, 70% loan to cost financing, that's $70 million in debt, and then they need to raise $30 million of equity. Well, once they develop the project, they need to refinance out of that construction loan. And what we've seen is, especially back in 2020, 2021, 2022, when rates were lower than they are now, groups were taking out construction loans and anticipating that they would refinance given where the current market was. They weren't really anticipating the rate hikes. So now where we are today is there are some developers who are going out to refi out of their construction loan, and they can't hit the requirements that these lenders are requiring, like a minimum debt service coverage ratio, which means that the debt service needs to be covered by the net operating income that the project is generating by a certain amount, right? And similarly and that's for more so like, let's say multifamily, so apartments. But for condos, if the lease or the sales schedule has taken longer than anticipated, and a developer had, let's say, a floating rate loan, their interest rate is increased. They're not able to pay down that loan with proceeds from the sale of these units as quickly as they anticipated. So they're incurring more costs and interest is piling up. So the profits aren't as they anticipated initially.
Okay. Matt, again, working with buyers, hesitation. We've gone through lots of hesitation to want to actually pull that lever and say, hey, I'm ready to do something. How do overall economic issues, forget interest rates, forget, a whole bunch of things, but how do overall, especially in light of where we are today, less than a month away from a major presidential election, and people focused on kitchen table issues, okay? Price of gas, price of eggs, and if I hear that one more time, I'm going to blow, my head's going to blow up.
So we're not talking about the people that have been saying the market's going to crash since 2020, right?
Whatever.
We're leaving those out.
If it applies.
Okay, because they still exist.
Of course, it still exists. But are economic issues also getting in the way, in a major way, with buyers, probably first-time buyers more than anybody else, in actually saying, okay, I'm going to do this because I mean, I remember, and I probably said this before, sorry, but when I was buying real estate before I was even a real estate agent, I would buy in any market. I didn't care. As long as I was comfortable with the price, I did it. You know what? If I wanted to sell a year from now, I sold it. And I never lost, but I sold it and I bought something else. But it's like, what is the big deal? So are economic issues, back to my original thought, really a deterrent these days?
I don't think they're necessarily a deterrent because New York City especially is you're buying into a way of life. You're not necessarily buying into just a piece of real property or shares in a corporation. You have to want to live here because it's not cheap and it can get hectic and there might be a lot of inconveniences, traffic, what have you. The price of eggs is not going to deter someone from buying a $3 million apartment. Let's just be real. And we're New Yorkers, so we don't really drive. So gas is not an issue either.
Correct.
A buyer is always going to have... I don't even
know what the gas prices are. I don't drive. It's like, who cares?
But, we just...
Get on the train.
We just did something on the show I do with Ari on the 13th floor where we went over common buyer objections. And
Perfect.
The overarching theme of that was, are these real buyer objections or you're just simply not ready to buy? It's the buyer that comes in and says, I don't want to make an offer on this apartment because I don't like the wallpaper in that powder room.
They're excuses, not objections.
Right, they're excuses. So, I always tell clients before we even start in the process, I say, my job for you is to act as your urban Sherpa. I'm your advisor. Your job is to walk through a threshold of a space and see if you can envision yourself calling this home. I will tell you if it's a good idea to buy it or not, and if so, how much you should be spending on it. All you have to worry is get that feeling. I mean, I lived in an apartment. I've lived in New York City my entire life. Every apartment I've ever lived in, when you cross the threshold in, that's the one. And as hokey as it sounds, most clients that I've worked with got that feeling. Some didn't. Some were just like, I want to live in the West Village. Mm-hmm. So they made some sacrifices. But it's
always about sacrifice when you're buying in this town.
Right, but it's a lifestyle choice. You're not buying this, you said hold horizon 3 to 5 years. I tell people 4 to 7. Because 3 to 5, you're lucky if you break even. You'll probably marginally sell it at a loss with closing costs and everything. But it's really, people are not giving economic objections. This world has been chaotic for the last 4.5, 5 years where everything's upside down and nothing seems to ever make sense. And, nothing shocks me anymore, basically, when I turn on the news. So for them, I always tell buyers, you need to focus on you. This is about you. This is not about the wider stuff going on in the world. When it feels right, you'll know. And then it's my job to make sure you can get to the finish line in a way that makes sense for you financially and emotionally.
I've always said, listen, when you put your head on the pillow at night as a buyer, you make a decision you want to buy something. If you put your head on the pillow and you feel good that I'm doing the right thing, I'm making the right deal, I'm doing whatever, then it's okay.
Right.
Everything else kind of falls into place. But yes, it's very highly emotional here in New York City, and on and on and on. But, the price of eggs, really, give me a break. Jared, when you're talking to I'm sorry, I can't, kitchen table issues make my hair want to fall out, okay?
A lot of kitchen puns going on.
I mean, we are the home of the $32 omelet, by the way.
Listen, I bought a thing of mince the other day, and the guy on the corner said $4, and I looked at him and I said, no, I'm just taking one. He said, I said $4. So I get the eggs, okay, and I get the gas, but $4 for a little thing of mince? Okay, whatever. When you're talking to your agents, what impact does the rate reduction have on long-term costs of borrowing, when they're considering the higher closing costs, as these guys have said before, higher taxes in New York City for the last, 7, 8 years? What are they, how are they looking at the whole picture? I mean, do you hear horror stories that buyers are telling your agents, hey, I can't do this because, the long-term cost of borrowing? Do they even understand what the long-term cost of borrowing is? I'm not quite sure they do.
No, but they also don't understand their long-term costs of Starbucks every day. So,
well, there you go.
Or the long-term cost of renting.
Exactly. And that's a perfect segue. So if you overgeneralize, there's 2 different buyer pools in the city. You have your luxury discretionary buyers, that need to purchase when they feel comfortable. And any sort of external event that can give them pause is an excuse to be able to delay, right? So you can use the election as an easy thing that, discretionary cash buyers may say, well, I'm going to wait till after the election, right? We saw a really big push of, high net worth individuals buying luxury properties at the start of this year. And as some of the economic and geopolitical things unfolded in March and April, that slowed down. The other really big driving force in our market to drive transaction volume is first-time homebuyers. We saw them come out in huge waves as the initial COVID lockdowns unwound in late 2020 and certainly into 2021 and into 2022 until the rates started rising. They've been driven back to rent. Why? Because there hasn't been any appreciation recently. They didn't want to go illiquid, and the rates have been high. So the rental market has been artificially high, and it's been a lose-lose for people because you can pay a high interest rate or you can pay an astronomically high rent. The reality is right now, the first-time home buyers are going to leave the rental market and start moving back into the sales market. This is going to increase demand before you have a corresponding increase in supply, which again goes back to why there's a first-mover advantage, because you can buy the home for a lower rate or a lower price with more negotiability and then refi later, right? You have this amazing thing where you can refi as the rate goes down. Absolutely. And some banks are giving you deals for your first refi anyway right now. You also have the Paris, a new condo conversion. I was actually quoted in a Real Deal article the other week. This is the first FHA-approved, quote-unquote, luxury, I call it affordable luxury, condo in Midtown. So buyers can now purchase a very nice one-bedroom for as low as $900,000 on East 46th Street and put as little as 3.5% down. This creates an amazing opportunity for someone that's been renting, may not have the liquidity for that typical 20% down payment, but has the cash flow to support that loan to be able to purchase. So I do see people coming off the sidelines to be able to start purchasing, coming off the rental market. Zooming out, New York City has not had any appreciation in 8 years. If you zoom back out, the last time real estate was as expensive as we are when you isolate for a price per square foot for condos was in 2017. We had legislation and fueled, slowed down. We had changes in tax rates. We had the change with the SALT on the federal level. We had COVID. We had interest rate rises. And prices have clawed their way back over the last 18 months. But there is no other market in the country that's desirable that hasn't had any real appreciation in that time. Everywhere else has gone so high. So New York City is actually not so expensive right now. And when you look on a global level, it sits right in the middle and being an incredibly balanced market. It's not in bubble risk. It hasn't seen huge appreciation. It certainly hasn't seen depreciation. New York City is the Swiss bank account of New York City real estate, where you can store your money, where you can enjoy the quality of life and all the amazing things that New York has to offer. And it is fundamentally a relatively affordable asset right now. And I believe it is poised for that breakout. I think we're sitting in 2009 right now from a price perspective. And I think we have 4 to 5 years to run as this market unlocks and breaks to the upside. So it is a phenomenal time, in my opinion, whether you're a high net worth individual looking to move money around, whether you want to, sell high, from other markets that have experienced that boom and buying in New York City now, or you're a first-time home buyer that wants relief out of those high rental rates and to begin building equity, as I do believe prices will unlock.
Well said. Spencer, so do you work with any clients, developers, or anybody else here in New York City? And if so, what is your impression, knowing the market from a few years back when you were in residential, what is your impression of what's happening today, last 2 years in New York from a market perspective?
Yeah, so we do have a number of clients who are based in New York City and working on projects in New York City and the surrounding boroughs. And I think, what we've noticed is they're focused on the fundamentals of their project, right? They want to make sure that their project is going to pencil if rates are up by 50 basis points or down by 50 basis points, right? If it's going to take 2 years to sell out of their condo development or 3 years or 1 year. So obviously lower rates are going to make them a little more excited about getting started with some of these projects. And I think, we will find ourselves working with more developers around the country, but especially in New York City as rates decrease. But I think they're just as bullish as ever.
I may have somebody for you. We'll talk about it after the show. Coming from the Midwest, wanting to invest in a development here, conversion, whatever, and maybe you can give us some pointers. Steve, let me ask you a question. So how have private lenders and banks adjusted their terms for portfolio loans or bridge loans following rate cuts? I said, I think at the top of the show, that bridge loans will be becoming cheaper for the end user or the person wanting to finance? I'm not quite sure. I don't necessarily understand how that all lays out.
Sure. Well, we don't provide. My team doesn't provide specifically bridge loans on residential real estate. However, what we see with our affluent client base, especially with the appreciation in the equity markets, a need to, let's say, leverage those assets versus selling those securities and having tax consequence, and then potentially taking advantage of some of the tax benefits of borrowing against the real estate later. So to answer your question, we see a number of our affluent clients borrowing against their securities to actually close on the real estate in cash. And those lines of credit are typically fairly easy to facilitate, right? The underwrite is not as cumbersome as, let's say, a mortgage transaction. The risk with those is they're variable rate lines of credit. So if rates do go up, the cost to borrow would go up. And they also can be called. So if the value of that security were to decline because of a shift in the market, the available line of credit may be reduced, and then the line called. Where with a residential mortgage, even if the underlying asset, the real estate declines in value, we're not calling that loan and reducing the size of it. But we do see a lot of that. And then what we're actually seeing with Uber Wealthy is then us extracting the equity post-closing. And I'm not a CPA, so I can't give, tax guidance. But my understanding is that many of these affluent buyers, once they extract the equity from the property post-closing, if they deploy that into an investment vehicle of some kind, they end up with the ability to deduct 100% of the interest expense on that mortgage against yield in that investment portfolio. And so there's some massive advantages to actually, buy bigger, buy in cash via some sort of other vehicle.
This is actually, I've noticed this
The
year
real
more
estate
than
agents
anything.
love that. Thank you.
Yeah, this year more than anything, I've noticed a lot of my clients, rather than going the traditional financing route, will borrow against a portfolio of their securities. It's so much easier to do. It allows you the leverage to buy in cash.
100%.
And then you basically, the repayment options are typically kind of more flexible than a traditional mortgage. If you can qualify for it, it makes so much more sense.
And we take, I'd say 50% of those lines, we take them out with a traditional mortgage post-closing, right? But for the agent, you have much better execution, right? And negotiation capability as a cash buyer. And then again, there's some of these tax advantages to actually extract the equity at a later date. So it's a win-win.
It is a win-win. All right, we've got to take a quick break. We're coming back right after the break. This is Talking New York Real Estate on the More Network. Don't go anywhere.
This podcast is supported by the More Network, powered by Brown Harris Stevens. Real estate touches every aspect of our lives, from design and architecture to investing and the economy. Now there's a way to get all your real estate information in one place, the More Network. With more than 20 podcast and webcast series, the Mastery of Real Estate Network is powered by Brown Harris Stevens, one of the country's most distinguished brokerages. Discover advice from notable entrepreneurs, compelling topics, and access to top global real estate experts. Subscribe to their YouTube and Apple podcast channels by visiting getmorenetwork.com.
Okay, everybody, we are back. So, this is the segment where I like to talk about the current state of the marketplace, okay? Financing questions, financing conversation. We've been doing that for a couple of weeks. But I like to talk these days, as I said earlier, because we are under a month from the presidential election. Everybody's concerned about, pricing out there that really still hasn't come down. Even though week after week I've been talking about how inflation has really come down, almost at that 2% point that the Fed is looking for, et cetera, et cetera. But people are still skeptical. So, Matt, let me ask you, what is the current state of our market right now in October, early October, in New York City?
Despite lower than average inventory levels and year-to-date contract activity that is lower than it normally should be, I actually do a report every single Monday that compares year-to-date metrics in Manhattan and Brooklyn against the same time period from the previous year. And while 22 and 23 were kind of oddball years with atypical inventory cycles, I have noticed a substantial increase in activity, especially in Manhattan, post-Labor Day. I think that we were going into the summer season with a election that people were, for lack of better words, kind of numb to at that point. Like nothing would shock them. With Biden dropping out and Kamala Harris stepping in, it kind of shook things up temporarily. But I also think that just because there is so much going on globally in the world, that people have been sort of probably the best way to put it possible, kind of numb to everything that's going on. And they're really focusing on themselves and making sure that their families are secure and their finances are secure and their investment goals are secure. And part of that does involve keeping your eye on the prize. So I anticipate actually a busier than usual couple of weeks leading up to the election. It's typically completely dead during an election year between Labor Day and November. I do think the savvy buyers are going to come out in droves in December, when we usually have tumbleweeds rolling through New York City, tumbleweeds and tourists.
Tumbleweeds, tourists, and holiday.
That's when the best deals are inked, December to February. And I think this year, especially if interest rates continue to drop, I think 5.5 is also the magic number. Mm-hmm. When that threshold is hit, it's going to be like we've reached critical mass. And I don't think we're going to see another 2021 by any means, but I do think that
I don't either.
People are more being driven by the fear that there will be more competition in the future. That's what's bringing these buyers that are currently at the table. That's what's bringing them there right now.
Jared, so from a global, war perspective, from an economic perspective, I mean, how is that, in your opinion, or based on people you talk to, how is that affecting this stage of our market, again, in October, going into the presidential election year and then beyond? I mean, all these global conflicts, terrible conflicts around the world, are they really, really, really affecting our decisions here in New York City real estate, or are they just something that you go home at the end of a busy day, put the television on and say, oh, God, here we go again? What's happening?
It's unfortunate to say, but I think numb is the right word. I think it's causing less of an impact now than it did in the first round, this time last year, March or April of this year, when the first Iran-Israel conflict was flaring up in a big way, just because it sort of feels like we've been here before. And, life continues to move and go on. And there's only so much time that someone could wait to put their needs first. Humans tend to be fairly selfish at the root at the end of the day. So there's only so much time that we can sit here and wait. So it's in the back of our minds, but it's no longer, I think, that guiding, blinding sort of thing, like I can't see anything but this. It's there, and I think it's being taken into account into the decision someone makes, but I don't think it's now that blocker or that excuse or the reason why someone's not going to do it. Again, it may inform or influence their decision to some extent, but I think now it's really what's best for me, how do I accomplish, and how do I really seize the day, carpe diem, with what's going on, because things are going to change, and which side do I want to be as they shake out?
Right.
I think also as the numbers become more favorable, people are more focused on the numbers and less focused on the sensationalist 24-hour news cycle. Right. Because ever since early 2020, if it wasn't one thing, it was something else that was causing you to wait. Yeah. And I think people are tired of waiting. And I think the last 18 months, just from a mindset perspective, have made people realize, as you said, life goes on. There's no reason to just sit on the sidelines and just keep waiting and waiting. I have to move forward, and I have to, you have to seize the day, keep living.
That's very typical of New Yorkers, and I've said this for years, from the 22 years I'm in the business, buyers and or sellers can only sit on the sidelines for so long. You cannot keep a New Yorker down. Eventually, they got to jump out of that chair and do something. Spencer, from your business perspective, have any of the global conflicts, any of what's going on in the world, has that affected your business at all, or is it still kind of high level from people thinking about how they want to structure their financial projects going forward?
Yeah, I mean, look, I'm sure it's impacted our business to a certain extent. I share the same sentiment as Jared. Like, we're seeing movement, though, the election is right around the corner and people aren't actioning right now, but people are planning. And where we come into play is in the planning phases of, let's say, the overarching development or of an acquisition of a commercial asset. So, post-election, I think there are going to be a lot of plans in the mix across the country for groups who, have wanted to get back into developing, but haven't thought it was the right time just yet. And then I think as rates continue to decrease, we'll see more and more development, which ultimately will increase supply, which I think will have a significant impact on the ability for the end buyer to identify units.
Steve, so from a developer perspective, okay, there's been a little bit of a slowdown in building because developers, and I've said this forever, developers have been, having the same issue with interest rates and whatever else as the end user or buyer has had. Do you see more developers coming back to the marketplace seeking financing? Some are self-financed. I've worked with them. The last project I worked on that Spencer knows, they were self-financed. They didn't have a construction loan. They had nothing like that. But those who need to finance, you see them coming back, asking questions a little more, actively than they have been in the past because inventory is down on the development side and otherwise, but developers haven't done anything. And my concern is that once they start and they, pull that trigger, it's going to take years before that inventory gets to marketplace. We still have something like 50,000 units available out there to sell, but, in the right market conditions, that can go pretty quickly. Where are the developers, right now as far as financing is concerned?
I think there's different segments of developers, right? You have the Relateds and the Taconics of the world that are these, large, Extel. They have access to capital markets. They have a lot of, equity that they've raised. They can borrow. They can create bonds in Israel if they need to. They have a lot of access to different capital. And so I think for them, while they'll focus on condo, I don't necessarily think there's as much upside for them in condo today, so they're not as focused on it. I think the smaller developers right now are just trying to figure out how they make it through to the next cycle, right? I think that, their cost to carry these projects, right, today on a variable rate loan should create an opportunity for current buyers because, their carry went from $40,000 a month to $80,000 a month as a developer. And so they would rather sell the unit, pay down the debt, and move on to their next project. And in many instances, while I'm sure you can provide creative financing, there may not be enough equity in the projects anymore for you to put together some sort of preferred equity position, right? So, that said, if you have a well-conceived project and you have capital, look at Naftali Group. Look at what they're doing.
What is that equity? Sure. What is that equity requirement?
Yeah, so it depends on the project. It depends on the location. But to Stephen's point, some groups that we're seeing out there when they're refinancing out of their construction loan, they actually have to come out of pocket and actually bring more equity to the table so that the stabilized lender or the lender providing the loan at stabilization will pay off that construction loan.
Well, it's just like an end user. As a buyer, they got to put 20% down to get financing, right? In most cases, sometimes they put more because they have it and they want lower monthly rates, whatever. But for the most part, that's what they have to do. All right, let's talk about predictions. Where we are, we all discussed. The rest of 24, including this month, the election month next month, and the holidays come out December. What are your predictions for where we're going to end the year and start 2025 in January?
Well, I think I touched on it during the last round, but I will say I'm anticipating what I would call a slow burn through the end of the year. I don't think it's going to be a bum rush the minute the election's over. I also don't think that people are just going to stop cold turkey and wait and see because people are tired of waiting and seeing. So I think the smart buyers are definitely in it. Sellers that are on the market right now, this time of year in general, if you're on the market still and you're not making plans to take a break between the holidays, you're serious. And I also think, going back to something that was touched on briefly, we have a lot of new development projects in the city that are constrained by what I would call, they weren't uneducated financing choices, but at the time they seemed like the right choice, and then the market moved in a totally different direction. I have a lot of buyers that we are scouring new development opportunities where a mezzanine loan might have a big payment that's due, or the lender seems to be behind on their quota for the developer for how much they need to sell in order to meet their targets. And we're actively pursuing those projects because that's where the buyers are getting closing costs paid. That's where the buyers are getting the largest discounts. There's some developers that no discount at all. You want it? Buy it. Oh, and also non-contingent. And also you have to use this lender. But there are certain projects in New York City where buyers are making out fabulously. So, the opportunities are there. You just sort of have to, as I mentioned earlier, you kind of have to tune out the noise and look at the numbers and make sure that what you're doing financially makes sense. And if that all jives, go for it. Pull the trigger.
It's not a community decision. It's an individual decision
Exactly.
based on your comfort level. I totally agree with that. Steve, what do you think prediction-wise between now and the end of the year, and now and January 1st of 2025?
I really couldn't agree more. I think that the next few months will probably be somewhat, lightly bumpy, right? Kind of stabilized in that we're not going to see any real surge, in activity. We've seen an uptick. I think that will continue. I think that thoughtful agents that are thinking from like a sniper's perspective, like you just said, are the ones who are going to, really do well in this market. And then hopefully, listen, the underlying fundamentals of the economy are strong, right? Labor market's strong. Inflation has slowed. We just have all of this uncertainty. Right. But if we round the new year, the Fed cuts, money's a little bit less expensive, you allow the development community to become more active, whether that's in, multifamily or condo, I think we could see a really strong spring. Or at least I'm hopeful for that.
Close us out.
Well, there's real estate salespeople that will sell you anything and anything, and then there's real estate advisors, right? So buyers and sellers really need to work with an advisor that, to use that sniper, example, can understand exactly how to play for you and achieve your goals, right? Because real estate is hyper-local, hyper-personal. I wrote a piece last month after the Fed released the reduction, and it was basically a game plan. And it's a game plan for buyers and sellers. And very simply, they're not aligned. So if time is not a factor and a buyer is able to secure the right financing and finds a place, the smart money is buying now. They should buy immediately because you lock in future upside with the ability to refinance as rates drop lower. Sellers, though, meanwhile, again, if they don't need to sell with any immediate time frame, should certainly wait until the spring. Why? I believe you're going to have more demand, lower rates, and a hotter market. So what does that mean? The market's going to get pressed in the middle. So buyers can do fairly well right now because there is still less competition, although the market is picking up. I think the bandwagon effect, right? That's the big thing is going to start December, January, February. I think those buyers are going to get a little bit compressed because the inventory is not going to rise until we get to February, March, or April. So I think the spring is when you're going to see a market firing on all cylinders with a lot of new inventory and a lot of new demand, especially when you have then the people whose leases are expiring in the spring into summer coming into the market. So if you rewind that for a second, the best time to buy is now. The second best time to buy is probably going to be in the springtime, and maybe the worst time to buy from a less negotiability standpoint might actually be in that winter time period. But again, if you do it smartly, if you have a plan, you have the right people in your corner, there's not a bad time to buy. You may be able to get a bad deal or a good deal. So it's a matter of making sure that you get the right deal for you at the right time.
Okay, we're going to come back with my thoughts for the week right after these messages. Don't go anywhere.
Hi, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you know the right partner makes all the difference. At Roadway, we deliver an experience your clients will love. For specialized services and white glove care, choose Roadway. Want to learn more? Email me at steven@roadwaymoving.com or visit roadwaymoving.com.
Okay, everybody, we are back with my closing thoughts for this week. You've heard me say this before. Even in a defined buyer's market in New York City real estate, where there is more negotiation opportunity and favorable conditions for buyers, some still hesitate to make a purchase. One key reason is uncertainty about future economic conditions, especially if potential buyers expect prices to drop further or if they're concerned about the job security in a volatile economy. Rising interest rates, even if lower than they've been recently, can still make buyers cautious about committing to long-term debt. Additionally, stringent lending standards may prevent some buyers from securing favorable mortgage terms despite market conditions. Others may be holding off due to lifestyle factors such as waiting for a significant life change event like a marriage or a job change, or uncertainty about long-term plans in New York City. And yet people do consider that, particularly as remote work has become more common. Finally, the high transaction costs in New York City, including closing costs, taxes, and maintenance fees, can be a significant deterrent, making buyers weary of the total financial commitment despite the advantageous market. But then again, we all see what happens the minute the switch flips and we enter a very defined seller's market. Hold on to your hats, people, because the crosswinds out on the streets with all the buyers running down the street with their hair on fire to see property will be out of control. But it's all good. And that's our broadcast for today. Thanks to my guests for being here on set with me. You can follow me on Facebook, on Threads, Instagram, LinkedIn, or TikTok at Vince Rocco, or my website, thinkvince.com. Norman Vincent Peale says, shoot for the moon, everyone. Even if you miss, you'll land among the stars. And from all of us here at Talking New York Real Estate and the More Network, to all of you all around the world, thanks for spending a part of your day with us. Thank you for the ratings bump up lately. I'm so grateful, and I will see you next time. Goodbye, everybody.